Well, I think we're ready to get started with the deep dive this morning. So, welcome to everybody that's joining. Excited to have you on for this Monday, October 4th. I always have to look down at my page to remember what day it is. So, welcome this morning. So grateful for everyone that joins the deep dive as we get started and start the week this way, talking about some of the biggest topics in real estate. That's our goal for these 10 to 15 minutes to give you what you need to be the most educated agent on topics that are impacting real estate today. At KCM, we say we always want to save you time and money to be the knowledge broker in the market that you serve. So, last week we talked about one of the big issues that forecasters are struggling with right now, and that's forecasting the fourth quarter because of the anomaly year that we've had during the pandemic over the past year. And so, this week, if you saw the update or you got the email, we're talking about interest rates and prices. I would argue probably no other topic right now in real estate is greater than those two topics. Interest rates starting to rise and prices running extremely hot. And so we want to talk about both of those this morning. It's the start of the fourth quarter. We're now in October, as hard as that is to believe. Just around the corner is the coming new year. And we're going to talk about where we're at right now with interest rates and prices. Like I just mentioned, as folks are joining, we're going to be kind of taking a deeper dive into both of those topics. Just a couple of weeks ago, I was on with Leslie Appleton Young talking about interest rates. And now we're at a place where we're seeing interest rates rise. And I'd be interested where you're at and lenders that you're talking to. Are you seeing those interest rates rise in the area you're in, or have you seen any impact on that? But let's maybe start our deep dive this morning with that conversation around interest rates. So I'm going to start here with a quote from Sam Caters, the chief economist at Freddie Mac. It says mortgage rates rose across all loan types this week as the 10-year U.S. Treasury yield reached its highest point since June. All right, 10-year Treasury, if we want to know what's going to happen with interest rates, we're going to watch the 10-year Treasury. Goes on to say many factors led to this increase, including the Federal Reserve communicating that it will taper its support of the capital markets. I'm going to talk about that in a minute. The broadening of inflation and emerging energy supply shortages, which compound other labor and material shortages. What's the bottom line here? A couple things are happening right now. The Fed has come out and said, we're going to start to taper or pull back our purchases of mortgage-backed securities, and the market is starting to price that in, and we're seeing higher interest rates. The economy is improving, no doubt, not at the speed that maybe we would like to see. Unemployment's not down to where we need it to be, and we've got supply chain issues in a lot of different places. Housing, so far has been immune to that. But no doubt the impact is a higher 30-year fixed interest rate. And this is what this looks like going all the way back of January 2020. Now, if you think about it, what I mentioned when we were on with Leslie Appleton Young just a couple of weeks ago, we have the health crisis, the pandemic kind of hit. Fed has to try to influence mortgage rates to spur the economy on, and we see the drop in rates. The economy is improving. And Fed says, hey, we're going to start to pull back on all that support. Interest rates are going to rise. Now, a key indicator of rising interest rates is an improving economy. So we always have to keep that in mind. That is a good thing. But no doubt, folks are like, well, I missed the boat on 2 3/4 interest rates. Maybe they did. Maybe if somebody bought a house last year and got that, you didn't get it. But we're still right at 3% for a 30-year fix, 3.01%. Phenomenal interest rate on financing for a home. If you think about us talking about a rising interest rate environment and being at 3%, it sort of seems like that should be, not possible. And oh, by the way, I'm not here today to say forecasters are calling for extremely high rates. In this month's monthly market report, which will release on Friday if you're a KCM member, we go in depth into interest rates, what forecasters are saying, what's on the horizon, what does all that look like. And again, middle of next year, I'll give you kind of the punchline there. We're looking somewhere maybe 3.5%. So not a dramatic rise in interest rates, but it will cost more. Okay. If we want to put this into perspective, and here's what I would be doing, here's the slide that I would take a picture of. What we want to do is we want to put this into perspective. And this is a look at historical mortgage rates by decade. Now, we know we go back into the 70s and 80s, we're looking at 8, 12% there, and 90s, a little bit higher, but not as high. And the decade of the 2010s, the average interest rate was right above 4%. With everything we see right now in housing, I don't see a dramatic, departure from low rates, but somewhere in the neighborhood of 3.5% to 4% by the middle of the end of next year. So prices are going to go up. It's going to cost more. And I'm going to talk about prices in just a minute. But, at the deep dive, we're going to always try to keep you up to date on what's happening in this area. And we're starting to see this turn in interest rates. So I mentioned we were going to talk about two things: interest rates and pricing. Big pricing news coming out. And I want to get you up to speed on this because, many people looking at it saying, hey, I don't know if I want to buy right now because prices are so hot. We're running hot in pricing, and no doubt we are. I'll start here with a quote to kind of address this issue. Bill McBride, the Calculated Risk blog, says, my sense is the Case-Shiller national annual growth rate in housing of 19.7% is probably close to a peak, and that year-over-year price increases will slow later this year. So Bill McBride runs a blog, Calculated Risk. He called the crash back in 2008. We refer to Bill a lot on the deep dive and here at KCM, saying, hey, the most recent Case-Shiller year-over-year price increase number, 19.7%, probably close to the peak. And a lot of people going, I hope so, because we're seeing a lot of appreciation. If I look at the most recent year-over-year price appreciation numbers, these are from July. This is the most recent published information, what would be talked about in the news if your client says, well, I just heard prices are up almost 20%. Yeah, that's where this is coming from. FHFA, 19.2%, CoreLogic, 18%, Case-Shiller, 19.7%. Let's call that a lot of appreciation. Now, people ask different times, why is there a difference in some of these numbers? They're all sort of, compacted tightly together, 18, 19%, but they're looking at different data. What we want to look is the aggregate of, okay, what's happening with prices? And we're seeing extreme amount of appreciation. All of this due to the lack of supply of homes on the market. So whenever there's a lack of supply, it keeps that upward pressure on prices. As we see more inventory come into the market, that will bring pricing relief. But so far, we haven't seen that pricing relief because we've seen this frothy market throughout the year and many people wanting to buy a home. Matter of fact, as we look across the country, there are 4 regions right now with more than 20% price growth across the country. You see the Pacific area, the mountain area, the New England and South Atlantic, over 20% appreciation. And a lot of people looking at it going, how long can this last? How much appreciation can go forward? And is it sustainable? And I think that's the question on a lot of people's minds relative to prices. Now, we're watching that at KCM, and I think there are some markets right now where folks are coming in, all cash buyers are coming in, and there's this frenzy, and we certainly expect that frenzy to start to die down as interest rates rise, as prices rise, as more inventory comes into the market. But I want to go to what Ivy Zelman says, because I think this is probably going to be the biggest issue. And this is where I would tag somebody, I would talk to somebody in my office, because agents are going to get confused, clients are going to get confused. And it's this. Ivy Zelman says, closings are set to decline roughly 10% year over year in the second half of 2021. And home price appreciation is on the cusp of flipping to a decelerating trend. So let's go back to what Bill McBride said. He said 19.7%. I think we're at the peak. Ivy Zelman saying, I think we're about to flip into a decelerating trend. What does that mean? If we look at the lack of supply and prices going up because there are fewer homes on the market, as more inventory comes into the market, as prices rise, and as interest rates rise, they see appreciation starting to decelerate. Meaning if we're at 19.7% 7% right now. Well, what's the next stop on that train? Maybe it's 18, 17, 15. Think of that in a curve. As we start to see the appreciation start to decelerate, people are going to say, well, what's going to happen next? I see headlines that, year over year, home sales are down. I know that forbearance is over and people can't make their mortgage payments. Oh no, here we go again. We need to be on top of this decelerating trend in appreciation and be the knowledge expert in our office with the clients we serve and everybody that we talk to, because this is going to be something that's going to be talked about a lot in real estate. So if we look at this, we think about deceleration and appreciation, all that means is we will not see as much as what we've seen. Remember, average appreciation for the last 20 years, 3.8%. What have we seen in the last couple of years? We've seen that average uptick to 4.1%. Homes could appreciate at 5% per year, and they would still be above the 20-year average. So don't be afraid of decelerating appreciation. Be on the lookout for it, and be on the lookout to be the knowledge broker in that area, because this is where it comes into conversations with people to say, you know what, I see what's happening in housing. I'm not sure I want to buy right now because prices are going to drop. Well, oh, by the way, let's use this as information in having that conversation. Home price expectation survey just came out, and this is a look going forward at appreciation on home price performance. They're saying 2021 at 11.7%. Now there's a difference between year over year appreciation and what they're going to call annual appreciation, but I think they're probably a little light there. 2022, they're calling it almost 6%, and then I'm going to call it falling into a more normal pattern in 23, 24, and 25. No depreciation anywhere on what forecasters are seeing. That's a big piece of helping clients make a powerful and confident decision today, because many don't feel powerful and confident relative to price appreciation. They feel like, here we go again, we're going to run into trouble. And when that happens, this whole thing's going to fold. And here's what I'll give you. I'll give you one last slide before I turn it over to questions. I'm going to ask Jessica here in just a minute what questions you have, if you have any out there. If you look at going forward, the expected home value change from today through 2025 is 31.8%. So the question is, would you buy something today? Would you invest money today? Hypothetically, if you're making an investment, and I'm not saying a home is purely just an investment, it's a place to live, but would you put that money there banking on a 31.8% return? Now, I'm not making the argument that a home should be solely an investment, but I'm saying it's the exact opposite of should I buy today, because I know that prices are going to go down. There are not a lot of people that aren't in our business that realize this. They think, you know what, pricing's running hot, and it is. There's been a frenzy in the market, and there has. And oh, by the way, homes are underbuilt across this country and expected to appreciate by 30% going into 2025. That's the message that we have to deliver to all the clients that we serve right now. So I hope this deep dive is beneficial to you in helping communicate what's going on with interest rates, what's going on with prices, so that we can get the truth out in the market. If you're a KCM member, all of these slides are in the member area for you to use right now. If you go to the KCM members Facebook group page, there'll be a link there. If you're not a KCM member, start a 14-day free trial. You get access to all this. You'll get the monthly market report, because of the next 90 days between here and the end of the year, there's going to be confusion in interest rates and prices. I will guarantee you that. So start that. If it's right for you, we'd love to have you on there. So Jessica, I'm going to pause for a second. Any questions we have right now?
Yes, we just have one from Adam. He asked, what do you find to be the best way to explain these to our clients and customers that might not understand the weight of what interest rates moving as they are?
Sure. Great question. Adam's question was, how do we best explain the weight of a change in interest rates? I talked about this last week. Now, if you weren't on the deep dive last week, you can go back in, and inside the member area, in the KCM member area, there's an infographics section, and there is a customizable graphic for the cost of waiting. And what you do is you type in there what your loan amount would be, and let's say hypothetically it's $400,000, and then it calculates where interest rates are at, and with the movement in interest rates, what's that going to cost you? Okay, so if you're going to borrow $400,000, as interest rates rise, it's going to cost more. But that cost of waiting graphic inside the member area in infographics is what you want to look at. Now, last week on the deep dive, which is archived here on the Facebook page, you can go in and access that and watch the brief demonstration that I do on that. Any other questions? All right. Well, we will wrap on that. As always, so grateful for everybody that joins the deep dive to start this Monday morning. Good to see you. We'll see you back. I don't know. We won't be back on next week. It's a holiday, Columbus Day, but we'll see you back here in a couple of weeks. Take care.